WSTU does not endorse products that may be mentioned. Any reproduction or retransmission of this broadcast is strictly prohibited without written consent of WSTU. It's time to call in with your questions and comments at 220-9788, 220-WSTU. And now, here's Casey Ingram.
Tired of lines at the boat launch, sun damage, or not using your boat because of the hassle? Call Meridian Marina and Yacht Club because we do all the work so you can enjoy your boating lifestyle. We store your boat inside, launch it with a wash with just 30 minutes notice, and rinse it down before putting it back. Need new electronics, service, detailing, bottom paint? No problem. Our experienced certified techs will make sure your boat is in tip-top shape and ready to head to the sandbar, fishing, or the Bahamas. Call us up at 772-221-8198 or visit us online at meridianmarina.com. Well, good afternoon, folks. I have a great show on tap. We've had a lot of train news in the stories here lately over the last year. And frankly, folks, you all know me. I say it's still not a done deal. And the biggest reason is the financing of the project. Since its inception, it has been scrambling and desperately seeking financing, and they're still at this place today. So joining me by phone is Mark Muller. He's a business lawyer who spent over 20 years in corporate and project financing. He really knows how these companies truly get financed and when bond investors do invest, why they invest. So, Mark, are you on the line with me now?
I am, Casey. Thanks for having me.
Absolutely, Mark. Well, I appreciate you joining the show. Just said a little bit about yourself, but can you tell me a little bit more what you have done to look into this project? What made you follow the All Aboard Brightline Virgin Train project?
Yeah, it's hard to keep up.
But it is.
It's been intriguing to me from the original announcement because, at first blush, I think most people who just have a basic business understanding of transportation and passenger trains, it was a surprising notion that a company would be trying to be the first in over 100 years to have a completely private passenger train. The economics of it were certainly speculative to begin with, and now I've spent around 3 years, probably not quite as long as you have, kind of observing this and the failure to finance it and kind of some of the obvious problems that would lead to non-financeability for this entire project. It's been very curious to me, and of course, it's not for lack of trying. They've done their best with professional investors, and now most recently they're taking a shift in trying to take this to the public markets because their efforts have been entirely unsuccessful with professional investors.
You certainly have. And folks, we're going to talk about, we actually got a chance here to kind of pull the curtain back behind the wizard, and that is they had to file an SEC filing, Security and Exchange Commission filing, because they're trying to issue stocks, as you were just saying, a public offering. So, folks, we're going to be talking about that specific filing today. We'll have some screenshots of some of the issues we're going to be talking about. But if you want to look yourself, it's real simple. Just Google SEC Virgin Trains, and it'll pop right up on your search, and you can look at everything we're talking about for yourself online. So, Mark, let's start out here with the latest. There has been 3 renditions of names. They started out All Aboard Florida. That didn't work, not successful. Then they changed it to Brightline. We can say that's now failed because now they're Virgin. What do you think about that? And what did you find out in the SEC filing?
Yeah, the SEC filing. So some of your listeners may not know that an IPO, the significance of an IPO is that it affords a company the ability to sell their stock, for their stock to be traded in public markets, which means that anyone, literally anyone, whether they're a qualified or accredited investor or not, are capable of making an investment and trading those shares, just like you could in IBM or Google or something else. And because of that, the SEC says, well, if from a securities law standpoint, the laws provide that if you're going to sell to non-professional investors, that you're supposed to disclose certain things about your company to make it transparent. And so what they've had to do, and being unsuccessful in selling to professional investors and now ultimately trying to sell to everyday members of the public, they've forced themselves to have to report some things in this S1 filing that you referenced that they probably otherwise didn't want to have to tell us, because the document itself is quite revealing. And for those of us who have been skeptical about the financial viability of this project, it's only proven that it's not.
Correct. It is a tremendous confirmation. And we'll kind of start out. I know that there's a lot of risk factors in that, but let's start out with that Virgin license agreement they just got. In the news, it sounds like Virgin is an investor. Is that what you found out through this SEC filing?
No, the SEC filing makes it clear that this kind of media hype around this being an investment or partnership by Virgin, the Richard Branson affiliate, is quite overhyped. It's a contingent investment in that it only has to be made if the company successfully goes public or if they otherwise raise the roughly $2 billion that they're looking for. So there is no current investment by Virgin at all.
So they're essentially licensing to use their name.
That's right. It's really the opposite situation. They seem to be going to Virgin and asking them for the right to buy their name through separate payments that are identified in undisclosed amounts. They're not getting any money from Virgin to make this look more like a validation by Virgin. And
that's one of the first things that really stood out, because again, this is the third name, and they did put a lot of hype around Richard Branson and Virgin, and then it turns out they're trying another name, hoping to keep the smoke screen working and make it look like they have a big investor when in fact they're buying that name. So that was a big find. What else did you see in there, Mark? We talked about key factors that may affect the timing of cost of or their ability to complete the construction of the north segment as a risk factor. So I know you found a lot of different risk factors as you were working or looking through the filing.
Yeah, so that's a key part of this disclosure document is they have to provide risk factors and disclose those to investors, and they're not surprising to those of us that suspected these things. But this is only purportedly $100 million that they're looking for from the public, which leaves them, by their own numbers, which are probably have proven to be vast underestimates in the past, it leaves them billions of dollars short. So the risk to these investors that might buy this stock is if they're not successful in getting the other financing, and they haven't been for years, what happens? It's presumably headed to bankruptcy, and these people will lose their investment. So that's a huge risk factor that the people making this investment that have no guarantee that they'll be any more successful than they have been in the past at raising the balance of the money, meaning it's either got to come from their current financial backers or it's bankruptcy.
And I want to go over some of the risk. I have some highlighted, and Iggy from Impactful Media is going to be showing them on the screen. Again, you just need to go to the filing. You can read all this for yourself. But, risk related to their business. Prior to the South segment, they have never independently constructed or managed a passenger railroad, and they've never independently constructed or managed a passenger railroad outside of Florida. Now, as investors, Mark, that's a pretty scary proposition to have somebody running a business that they've never ran before.
Sure, and I think, you alluded to this, Casey, but I think what you're seeing in this Virgin deal, which really is a very one-sided deal, as we've said, in favor of Virgin, is you're seeing them lurch toward trying to gain credibility from Virgin, who has operated train systems in the past. But when you look at the details of this, quote, partnership, Virgin is going to have no obligation or role in the management of this operation. It's the same people who, as you say, have not done this in the past and haven't successfully done it here. And even with respect to Virgin, as has been widely reported, a similar joint venture where they actually had made an investment in Great Britain in a line, it recently was subject to termination and a bailout by the government. So even in situations where Virgin has made an investment in train lines, that isn't necessarily proven to be successful, even in parts of the world where train usage is much more common and customary.
Correct. Another risk, they admit it through this filing. Although we believe they can raise funds to complete their Florida passenger rail system, there are no assurances that future sources of capital will be available on favorable terms on a timely basis or at all to accomplish this. So, we've talked about this from the start. They have scrambled for funding from the start. They still are. Right now it mentioned in there their total indebtedness is approximately $625 million. I think you can talk a little bit about that and some of the previous bond sales that they did have, can't you, Mark?
Sure. So somebody might say, they were successful in raising $600 million in bonds through a 2017 offering. And so why are you suggesting that they can't raise money through bonds? Well, there's some devil in the details that people need to understand about that. And again, we haven't had transparency into this until this SEC filing. But what has happened is I'd equate this to somebody going to a lender and saying, hey, I'm going to start a company to build time machines, and I want to take a loan for that. Now, that lender is unlikely to loan somebody money to go build time machines that are never going to work out, and it's not a real business. But if in the course of doing that business, you bought a building, and that building had a value that the lender could go and foreclose against, they might loan you money for the building, even though they think your business is nuts. Well, that's kind of what the $600 million bonds look like today. Those bonds were restricted for use in the southern existing part of the rail, and they have a first priority security interest in the hard assets of the project. So it's secured by all the real estate that they own. It's secured by the $300 million-ish in trains that they've purchased. And the lenders in those bonds stand in front of the in excess of $1 billion that's been spent by Fortress. So those bonds are really not predicated upon the viability or profitability of this train that is certainly never going to be profitable. They're predicated upon the money that's been spent in the real estate and train assets that those purchasers of bonds believe they can sell to recoup their money. Now, when you exceed the value of those assets and you're actually making a financial bet on the underlying business, which is the stage that they're at now, which is why they haven't sold any more bonds in excess of that, it's a different underwriting. So the SEC filing makes it very clear that those bonds are first priority secured against hard assets, not against the viability of the business.
And that's very interesting. So what you're saying is that if more bonds were somehow to be sold, they would be in line second to be paid back. So if the company went bankrupt, these first sets of bonds basically have collateral to back them. The second set of bonds, there's nothing unless profit is built up.
Right, and the S1 disclosure makes it clear that the holders of those bonds essentially have a veto power over future indebtedness, and that's why in the S1 all the assumptions are predicated upon raising not just enough money to complete the northern segment, but also to redeem those other bonds and cash those out.
Exactly. And it does say that again right in the filing. And development and completion of the north segment is dependent upon our ability to raise funds through various potential sources, including a refinancing of the Series 2017 bonds through a new issuance of private activity bonds or otherwise. We'll move on a little bit from the bonds here because there is more devil or details in the devil, and that would be the ridership and revenue. So the ridership has been overly inflated from day one. And now Brightline, Virgin, whatever you want to call it, has been in business for a year. We have actual figures that have come out on the ridership. If you can pull up 16. From January to September 2018, passenger revenues was $4.7 million and ridership was 340,456. And that makes an average ticket price of $13.96. Yet in the SEC filing, Virgin estimates that their average ticket price from West Palm Beach to Miami is going to be $50. So you looked a lot at these different ridership figures, didn't you, Mark?
Yeah, and you've been all over this from day one, Casey. These projections that have been submitted by Brightline have always been incredible, and in fact, the Virgin line that was recently canceled last year in Great Britain, it was the same issue. It was an economic failure over irrationally exuberant predictions about ridership, and everyone suspected that. That's reviewed their materials, and this S1 only makes it more clear. They have lost presumably in excess of $100 million in 2018. They lost nearly $90 million just in the first 9 months. So their projected revenue of roughly $24 million for 2018 ended up being less than $5 million. And so, yeah, the ridership surveys that are relied upon for the projections and the financials in this S1 filing for an IPO, I believe are done by the very same people that have grossly overestimated the amount of ridership so far, verifiably, and that's not disclosed. There's no reference to the fact that they have been wildly inaccurate in their former predictions of ridership.
No, they make this tiny little statement that says the estimate of future ridership and revenue of our proposed Florida passenger rail service and the Vegas expansion contained herein are based on certain assumptions that may prove to be inaccurate or incorrect. So, may proves they covered themselves, I guess. But you know what? You remember?
That's right. And,
go ahead.
And that's the art of this type of filing. It's you have to disclose enough to make sure that in retrospect what you disclosed was not misleading. And in my opinion, they walk a very fine line in this. They have general statements about exactly what you read, the uncertainty of ridership, the uncertainty of being able to raise additional capital, and those are certainly true. And then they have a bunch of narrative in there about ridership studies and things and why they think this is going to be a very profitable business, which in my view is extremely misleading.
And when we're talking about ridership, if we can go back, number 9, back in 2014, if you remember, All Aboard Florida at the time sued to block the ridership information and sharing or the projections that they had to keep them quiet. And they did for as long as possible. But this SEC filing certainly, like I said, pulled the Wizards curtain back. And, speaking of the ridership, what's interesting with that, Mark, is quarter 1 was 74,000, quarter 2, 106,000, quarter 3 was 159,000. But while riderships increased a little bit, their revenues have actually, or their profit has actually, they don't have a profit. They're losing more money is what I'm trying to say as they go along. They're bringing in more people, but yet they're making even less revenues. So it's fascinating to follow because it means basically they have different specials. They might have a buy one, get one, get one free, or they've ran specials. We're opening up in the 305, so $3 and $5 tickets. So it shows they got some riders, but at a greater loss. And
yeah, and that's always been kind of the bottom line financial point to this is reasonable people can disagree as to the value of having a train system between two locations. To me, that's never been the issue. The issue is whether investors ought to be risking capital for it when clearly in almost every instance of a passenger train anywhere in the U.S., these lines have to be subsidized. So what's happening right now is they're creating artificial demand in review of their numbers by simply subsidizing tickets and making them low enough that people will pay for them. But somebody who might ride to Miami for $13 is on a single passenger ticket is not necessarily the same person who will pay $50 to eat for each person to bring their family on a one-way ticket. So it's very misleading in that regard.
It truly is. And in their filing, they estimate their average fares. I mean, this is, incredibly expensive. $100 per passenger from Miami to Orlando, and then Miami to West Palm Beach is $50 per passenger. Now, that's a one-way ticket. And if you have a family of 4, again, this is why people are not going to be using the train. The ridership is just not going to be as they claim. You were talking about some of the claims that they had made. They had 2 different studies done with Louis Berger. And, his ridership in the SEC filing, total passengers 6.6 million at $73 an average fare. So they come up with they're going to make 485 million. And I go back to that one statement. We looked at what they charged this year, and it's just about $14 a ticket. So from $14 to $73, that's a big jump. Pretty tough to do.
Oh, yeah, absolutely. And I'm no far from an expert on the economics of rail or the economic decisions that passengers make. But I have lived in 5 of the 8 counties that this train purports to be ultimately going through. And I have ridden a lot of trains, including the Acela line, many times between Boston and New York. So a lot of the comparisons that they're making in here are truly apples and oranges. And you're absolutely right. There's not only the cost issue, there's the issue that the Acela puts you in Penn Station in downtown Manhattan. and they're proposing to move you to the Orlando airport, which exactly no one headed to Orlando actually wants to be at. So
Right.
you've got to solve how you get from there to somewhere else. So these comparisons that they're trying to draw to convince people in the S1 that this has the same type of economics and same types of desirability as something like the Acela line in Northeast Corridor are just total fantasy.
It truly is, Mark. And as a matter of fact, Florida Not All Aboard had put together a paper about Acela really doesn't make money either. And you can go and research that on the Florida Not All Aboard site. But I want to point out something else with that Acela train, and that is that it carried back in 2013, this is from that paper, 3.3 million passengers. Acela serves a market area of 38 million. All Aboard Florida state serves a area of only 9 million. And yet they're comparing themselves as if they are apples to apples. So, if Acela has 3.3 million passengers out of a 38 million population, what can we truly expect out of 9 million? Certainly not the inflated numbers that Brightline All Aboard Florida has always purported.
It totally lacks credibility. I couldn't agree with you more.
And, the other thing I wanted to point out, the Palm Beach Post wrote a really good article at the end of last year. And, we talked about the losses that they're mounting. It lost 28 million in the first quarter, 28 million in the second quarter. But then in the third quarter, it lost 30.9 million. So greater ridership, but greater losses. So, Mark, what are these bond buyers? I mean, the bonds are out there. They keep getting extensions to sell. What do you feel is the future of these private activity bonds?
I can't imagine that a sophisticated purchaser of a bond offering would extend this type of credit that they've been seeking, and we've been proven to be right. It seems that Brightline always has an excuse for why these fail to price, whether they blame it on general market conditions or something like that. I imagine that if this IPO fails to issue, that they'll blame it on the SEC or a government shutdown or something like that. They always seem to have an excuse other than the obvious. And I think the most fundamental thing of all of this is the market decides these things. And, there
Right.
may be a lower bar to selling a private offering, a public offering to people that are non-professional investors. But the minimum investment in the bonds, it being at $100,000, almost necessitates that the buyers of those bonds are going to have a certain level of financial sophistication. And the response in the bond markets to this offering has been uniformly no thanks. And that's not going to change. It's only going to get worse as they continue to report these losses. And so I think you see them lurch toward this IPO, a totally different Hail Mary, if you will. And when they've disclosed these documents and these numbers in the IPO, they're, in my view, trying to create media buzz with smoke and mirrors to try to deflect from the obvious in that this is already a financial failure, by doing things like announcing a quote virgin partnership or throwing a train stop at Disney on a map or talking about LA to Vegas or Atlanta to Charlotte, anything other than the actual reports of their numbers that they're required to do.
Were you surprised the FDFC approved the private activity bonds here in Florida?
Yes and no. I think one of the things that we'll look back on after the markets kill this thing, and it's ultimately a dead deal. I think one of the most regrettable things is, unfortunately, people in governmental and quasi-governmental roles tend not to be the best judges of the efficacy or likelihood of some of these things. And you're seeing this repeatedly. You're seeing
Right.
municipalities talk about stations. You're seeing in
Yes.
my area a planned flyover over the railroad tracks because of concern about the volume of trains. So they're trying to create this air of inevitability about this. And unfortunately, many people in governmental and quasi-governmental roles actually believe that. So they're taking action and spending taxpayer dollars and wasting taxpayer dollars toward things like a tax subsidy toward a bond offering that they really ought to know is not economically viable. But the bottom line is they probably don't.
Mark Muller, I could not agree with you more. Thank you so much for joining us today. We're out of time now, but we have seen that here in Martin County locally with our local officials right up through the state level. So appreciate you giving us some real good insight to the financing of the train or lack thereof. Thank you.
You've been listening to the Casey Ingram Show right here on WSTU 1450, WSTU on Alexa, and WSTU on Google Home worldwide.
This is off air, Craig. This is off air. Oh, he hung up. Yep, he did. Talk to him real quick, but okay.
Okay, so the initial bonds